What's up guys, welcome back to the stockdads channel. My name is Chris and in today's video we're talking about 5 stocks to buy in November 2022. I'm going to be discussing all of these stocks based on their type of business, the revenue, the net income, the valuation, everything you need to know to why I'm buying these stocks. If you like these type of videos, make sure to subscribe. We have these every single week, talking about stocks to buy, day trading tips, market updates, small account options challenges, and more. This is the month to be thankful, and I'm very thankful for this number one pick. It's my favorite pick every single month, and that is Perry stock. This one constantly beats all expectations. It's extremely undervalued, and let's get into some of these numbers because numbers don't lie. Perry is in the ad technology business, all right? It's a partner of Microsoft for Microsoft Bing. That's 50% of their business. They also have another side of their business that is in display, connected TV, very diversified company. When we look at the revenue growth over the past 2 or 3 years now, not just a fluke, right? They've been consistently putting up 30% plus revenue growth. Even in a bear market this year, in a recession this year, we know ad budgets are getting cut. Look at Facebook, Google, Snapchat, Roku. Everyone is struggling right now except for Perion Network. They're doing phenomenally. Not just revenue growth though. This is a very profitable company. In their last quarter, they made over $20 million in net income. Net income growth, by the way, is well over 100% again for several quarters now. They recently even raised guidance for the rest of the year with the expectation that they're going to make 20 million more in EBITDA. Now you might be thinking revenue growth is on fire, net income is phenomenal. This company must have a really high valuation though. It does not. If you look at the PE ratio here, PE is only around a 15 right now. And when you look at other valuation metrics like the rule of 40, it definitely exceeds that. If you look at enterprise value, this is only a $700 million company when you take out the cash position net of debt, which by the way is zero. So they do have a net cash position of $350 million. It's increasing every single quarter. That is incredible, especially right now when a lot of companies are not growing and they also have very bad balance sheets. The CEO has said in the latest conference call, no slowdown expected for Q4 or 2023 because their technology is in super high demand right now. They're doing cookieless ad targeting and their ad performance is actually better, 2 to 3 times better than the Google benchmark and compared to cookie solutions. They have a lot of high profile clients like Albertsons, Mercedes. Their clients are increasing by the day. So very impressive. And if you look at the stock chart and compare it to the PE ratio over time, we can see that this company has actually gotten even cheaper, even though the business is doing better and better and better. So no brainer, number one stock for me every single month to recommend, or at least what I'm buying, is Perion. If you want to get all of these picks in real time, make sure to check out the StockDads Discord. We offer live alerts as well as education in there and live streams every single day. And we do have a weekly plan for only $25. That's the cost of a couple of coffees every week that you could instead convert into profit-making trades and education. 2 more quick notes on Perion. Number one, I mentioned previously that they are a Microsoft partner, right? Microsoft was chosen by Netflix to lead their advertising for their ad-supported plan. Perry is in discussions with Microsoft and how they can support that. And that could be a huge revenue boost if there are a lot of people that sign up for that Netflix ad plan. And 2, with the $390 million in cash that Perion has, they have said that in 2023, they are looking to make an acquisition. And the way they do acquisitions, it immediately benefits the net income because they look for profitable companies that can add on and create more synergy with their brand. Number 2 on my list here is ICLN. This one is actually an ETF. So Clean Energy ETF, and we know clean energy is going to be the big wave for the next 10 plus years, right? We kind of need clean energy to survive as a civilization. So I think it's a pretty safe bet to invest in it. Just me personally, I don't know about you guys, but as far as revenue and net income, we know that this varies a lot. This is an ETF, so it's made up of dozens of different stocks. Now, some of the standout stocks in this index fund include Enphase and Solar Edge. These are actually up on the year, and Enphase is up somewhere around 50 to 60% year to date. So a lot of those companies are killing it. That fund right now is down a bit year to date, but if you look at the long-term trajectory of this index fund, I mean, there's not a lot of index funds that can beat this, right? Over the past 5 years, this is up over 100%. And it makes sense, right? The demand for clean energy, green energy is only growing. You think wind, solar, hydrogen with plug power, just as another example, is the future. The whole Build Back Better thing and the Inflation Reduction Act had a lot of positive things in it for companies in this space. And I think that the more investment that goes into this, the more those companies are going to appreciate in value. Enphase's last quarter, they did 80% revenue growth. Just as an example here, right? 80% revenue growth, 400% net income growth. I mean, you can't beat that, guys. So in terms of the index funds, yes, last month I recommended QQQ. VTI is another good one. VOO, those are really good overall stock market index funds. But if you do want to try to get a better return and potentially invest into a particular space, in that case, I would say ICLN is a great choice. Another good thing about this fund is that it does have great exposure globally to many different countries and many different sectors. In terms of valuation, the average PE ratio in this index fund is about 28, which is high. It is higher than the market average right now, but I think it warrants some of a higher valuation because you're looking at extremely high growth in revenue and net income for a lot of these companies. And at the end of the day, it is a long-term investment. Moving on to number 3, Ford stock, ticker symbol F. This one is in the auto space. So this is one of America's biggest automotive manufacturers. For me, Ford stock is one of the value and dividend plays here. So jumping a little bit ahead, but if you look at the valuation here, PE ratio is somewhere around 6.5 here on this stock, which is very low considering the overall market, its sector, and the amount of growth that it has and the potential that it has for the future. Revenue growth in the past quarter was about 10%. They've actually been doing much higher than that over the past year. If you look at some of the past quarters, it's about 50 to 60% revenue growth. Ford's potential lies, in my opinion, is definitely those EV sales rather than their traditional autos. You look at the EV sales data in the past month, it was over 100%. Now they did start from a low base. They sold only a couple thousand cars, and even now they're only selling a couple thousand cars. Right now that's not saying much because Tesla is selling almost 10 times as much as they are every month. But I think that in the long term, this could definitely work out to something big. They're doing billions of dollars in investments in this space. Worth pointing out though that our adjusted earnings were down about 40% in the most recent quarter. They did book a loss on investments and they do have a lot of supply chain issues that are raising costs for them. With their balance sheet though, they do have about $40 billion more in assets versus liabilities. Lastly, a quick note on the dividend. Over the past couple of quarters, they raised it from about 10 cents to 15 cents, a 50% gain. A very nice dividend yield, about 4% right now. I started buying when it was about a 5% yield, so I'm currently really happy with my position. Stock number 4 is AMD, all right? One of the biggest and best semiconductor companies. So semiconductor chips are used for a variety of different purposes, artificial intelligence, gaming devices, they're big in consoles, and also data center. AMD is a really big growth company. You look at the revenue growth in the past quarter was about 29%, but looking at the averages over the past 5 years or more, their revenue growth has consistently been somewhere around 30 to 50% in most years actually. So even though right now there is a lot of inventory congestion and they have to mark down a lot of prices, they are still selling a lot and growing a lot. So when we do get into a good economic cycle where people are buying a lot more PCs again, because that is a struggling side of their business, that could be a big driver for their revenue growth to re-accelerate beyond 29% here. Net income, looking at those 5-year trends once again, it's somewhere around 20 to 100% plus net income growth. And they have a great team and great products. Like look at Lisa Su. She took this company from around $2 per share to a peak of over $150 per share. They've taken a lot of market share from Intel for those chips. They've gone from about 20% market share to 40% plus market share, while Intel has consistently been struggling. Technologically and executionally, they've been ahead of their competitor. The valuation for AMD is kind of interesting because it is a bit of a cyclical business. It doesn't always have a consistent net income every single year. But we look at some of the PE trends over the past 5 to 10 years, and right now AMD is actually at one of the lowest PEs it has been. PE of 44, that sounds really high, but it does have high growth pretty much every single year. Finally, AMD has a 2.4 current ratio, a balance sheet of over $3 billion in net cash, And in terms of actual cash, it has somewhere around $5.5 billion in cash on its balance sheet. So overall, a great situation. Finally, number 5 is going to be Amazon stock. Of course, Amazon is in the e-commerce space and also cloud with Amazon Web Services. Amazon is a $1 trillion company. Looking at the revenue growth, even in a year that is not great, and after the whole pandemic boom for e-commerce, a lot of people think that these companies are gonna die off, or a lot of them are not gonna grow anymore. 15% sales growth is still pretty good in this type of environment. Consumer is still pretty strong, even though there is all of this inflation going on. So similar to a lot of companies this year, Amazon has been not making as much of a profit, and this has a lot to do with cutting costs. So Amazon has recently laid off a ton of people, like Meta, like Salesforce, all these big tech giants have a lot of more employees than they really need. The latest quarter, I believe their income went down about 10%, but let's not mistake the fact that Amazon over the past 5 years or so has gone from a $3 billion net income to $33 billion in 2021. That's incredible. Let's not ignore for revenue, they are expected to make over $500 billion in sales this year. That's $500 billion in sales. So when they do become a leaner company, they cut off a lot of areas that just didn't make sense, that they were burning money in, just focus on the core business and make more money. And the share price is going to be rewarded, in my opinion. Obviously, Amazon's going to survive a recession. It's not going anywhere. It's a pretty solid long-term investment. It has been and will continue to be. You also tend to do pretty well when you buy Amazon at a high PE ratio like 90, and then you buy and hold it until they start making a lot more profits and it goes somewhere around a 40 PE ratio. I think that is pretty achievable once we get a lot of cost cutting down. Next year, analysts do expect this company to grow its earnings per share by over 90% in the next 5 years, grow it at a consistent 20 to 25%. Finally, Amazon's balance sheet is strong. It has over $100 billion more in assets versus liabilities. Cash and short-term investments, they have about $60 billion. So no worries about Amazon going bankrupt, obviously. I am interested in how Amazon continues to raise its value proposition for its Prime membership. They have raised the price of those memberships every so often, and that's an immediate boost to their profits. And there's not a lot of people that are gonna cancel their subscriptions. Let's be real, right? No one's gonna cancel their Amazon Prime at this rate. And they're constantly adding more features. They've just recently boosted their music streaming service. They invested into more content by buying MGM Studios. It's also interesting how much money they're investing into smart home devices. That could be a really big investment for the future when a lot of homes do need upgrading. And millennials do like devices that they don't really need, but are fancy and they can command them to do things for them. So there you guys have it. Those are 5 stocks I'm buying in November 2022. Hope you guys got a lot of value out of this video. Again, make sure to check out the StockDads Discord. This is our trading community. We have almost 2,000 members in there. We have trading alerts for short-term trades, swing trades, long-term investments, live trading sessions every single day where you can learn from the best of our experts. Go through our technical analysis course, our one-on-one mentoring with our roadmap plan, which was nationally recognized, and much more. Like this video, let me know in the comments what kind of stocks are you buying in November 2022, and I'll see you in the next video. Cheers.